Good afternoon, ladies and gentlemen. It is March 18th of 2024. Glad everyone could join us this week. Hope that everyone had a great weekend. We got a lot to chat about, and we look at the overall market right now. Generally speaking, everything as it relates to the S&P 500, a lot of the headline indices that we see still remain somewhat overbought over the short term. One of the big messages that we've been going out with to clients and advisors has been that bull markets tend to be overbought. Most of a bull market sits in an overbought condition. Now, does that mean that we don't have a risk of having a stock market correction? Of course not. And we do expect to have a correction here at some point. But what happens in terms of the headline index correction, we believe will look very different versus what the individual stocks underneath the hood are going to do. Given how concentrated the index has become within technology, we think that technology remains the area where that is most exposed to a correction and something possibly deeper than that. For those who have worked with us, know that we do believe that pockets of technology remain in a very, very dangerous bubble. And we have been working to try and avoid those areas of what we call bubble valuations versus the average stock that sits at very attractive valuations, that equal weight S&P 500, sitting in and around 15 to 16 times earnings versus north of 20 for the S&P as a whole. And then other areas that have deep value, such as emerging markets and banks and energy, that sit at a deep, deep discount to the S&P equal weight in anywhere from 9 to 11 times earnings. So that's kind of a high level overview in terms of the market as we go into mid-March. But let's go ahead and start the actual presentation. And really what we're calling this week's presentation is that Inflation 2.0. Now, we had an inflation report that came out this week, so we want to review what that inflation report said and what its impact is on asset allocation. Number two, what are commodity stocks trying to tell us, not just about the US economy and inflation, but what is it trying to tell us about China and trying to take clues from that? And then lastly, are growth stocks negatively exposed to inflation? We learned a lesson in 2022 as it relates to rising rates and inflation and its impact on multiples of expensive growth stocks. Now that we're in a more extreme bubble territory within tech, if rates do what no one is expecting, which is rise, not fall, what will that mean for some of these stocks? Now, we want to revisit that portfolio blueprint, right? So if inflation were to surprise higher and push interest rates upward, right? So we think that if inflation continues to surprise higher, and we'll go through that report in a second, that it's likely, that at least on the long-term rate side, that you see rates push upward. And everyone's sort of positioned for the other side of this trade. And then, of course, if that's the case, we actually think that value stocks will benefit from that because people are going to look for stocks and companies that do well in an economy with higher nominal growth that usually is accompanied by higher inflation. And that could come at the expense of growth stocks because A, we got to find money to buy those value stocks. So we sell some of the gains in the growth areas. And number two is when interest rates go up, the multiples on growth stocks come down because we're valuing those earnings 5 or 6, 7 years way out in the future a lot less when interest rates are higher. Why? Because interest rates give us an option to do something else with our money and also discount those future earnings way, way less versus a low rate environment. So that's kind of that inflation playbook that we use. Again, to review, if inflation surprises higher, we think rates go higher, and we back test that type of environment, value tends to outperform growth. So if the reasons why are confusing, just note that in history, it has tended to be the case that value or cheap stocks tend to do well over expensive stocks when inflation and rates move higher. And we saw, and this has been our message, by the way, for many months, is that we don't believe that the inflation cycle is necessarily over. We've been talking a lot about that inflation coming off these boiling hot amounts. We're going to come down just because of the math, right? So if you have 8-9% inflation, it's very easy to get down into that 4% level the next year if just things stabilize, right? Because it's just math. You're coming out year over year over a much higher amount. That said, the last mile to inflation is the hardest to achieve, to go from 4% to 2%. Because at some level, you will need almost disinflation or no inflation at all. And we look at the geopolitical picture right now across the world, it doesn't necessarily lend to a picture of smooth sailing for global commerce, right? There's a lot of hiccups, whether it's in the Red Sea or the Panama Canal. We look at energy prices. There's a lot of things that don't necessarily suggest that we're in this 0 to 2% inflation range. And so what we have seen here, and it's again suggestive of the report over the last week that came out last week, is that inflation is back on the rebound. We're now at 4.46% inflation. So here's the problem with the rate cutting narrative. The Fed's target on inflation is 2%. So in this environment back over here from 2014 to 2020, you can cut rates. Why? Because you're either below target of 2% or just slightly above it. But overall, you're in that target zone to be able to bring down the cost of money. At 4.4% or 4.46%, if you cut, do you think inflation is going to drop? No, it'll probably boost nominal growth in the economy, boost demand, and push prices higher, back to 5 or 6%. That's what logic would say. So with the economy doing as well as it is and inflation low or unemployment low, why does the Fed need to cut rates? There's only one real issue with the economy right now, and that is stubbornly high inflation at 4.46%. So we're not necessarily in that boat that the Fed's going to cut. And if they do cut, we think it'll be far less cuts than what the market's pricing in. And we've seen that started to reflect itself in the rates market. So we look at the 10-year interest rate, which is this chart here. It bottomed in late December. And in and around sort of that 3.8, 3.9% level. Since then, the long-term rates have started to move up. We had a back check, and now we're breaking out again. And at the time of this recording, right around 4.3, 4.31%. Now, 4.35 and above is a clear breakout from the prior resistance point, right? From a technical standpoint. So we want to watch that level. But breaking above that 100-day moving average is something that we are noting, we are watching. So that is important. It's an important level, and it's certainly contrarian to where the rest of the street is right now. So again, just a reminder, that leadership rotation, as a result of that, we want to be biased toward value, and we want to be biased against growth stocks. And what are the areas within value that we're focusing on? Energy, deeply discounted, 8-9 times earnings as a sector. Emerging markets, led by China. You have Facebook-like companies trading at valuations similar to where Facebook and Google were 2 years ago. Orphan growth, such as cannabis. That's another area that we want to be focused on. Materials such as chemicals or copper. We'll look through here in a second what that sector is trying to tell us about China. And then the banks, which are also deeply discounted. Let's look at some of these expensive growth areas. Now, everyone is positive on NVIDIA. We've talked about this endlessly, right? But I do want to note, sometimes picture says 1,000 words, that semiconductor outperformance versus the S&P 500 is back to those peak 2000 levels. The last time we saw semiconductors outperform the S&P 500 by this magnitude was at the peak of the dot-com bubble. Now, the revenue and earnings backdrop for semiconductors is vastly improved today than it was back in 2000. I want to be clear about that. That said, the way investors are behaving, the way that valuations look on paper is also very similar to 2000. So we want to be careful. You know what? Every stock, even Apple through its heyday, went through corrections. So it's okay to be patient. It's okay to say, you know what? Even if you don't agree with our point of view, wait for a pullback, right? Because it will happen. The stocks don't go up every single day forever. So wait for that pullback and be patient. Now, underneath the hood of that Magnificent Seven, the leaders continue to break down. Apple's fighting off that double top, right? That continues to break down both from an absolute and relative strength perspective. Tesla is experiencing a multi-year breakdown. Fisker, one of its peers, is close to bankruptcy, trading at something like 10 cents a share. The EV market is saturated, is in a price-cutting war, both in China and in the US. And quite frankly, the economics of making an EV car are not that attractive. And the only company that's really figured it out has been Tesla, and now it's going through a price-cutting war. So a chart says 1,000 words, down close to 55% from its peak in 2021. We talked about Adobe a couple of weeks ago. Came out with a terrible earnings number, or guidance number, I should say, the night before we recorded this video. So it's trading significantly lower. So we have a breakdown point here. Its thing is trading right around 510, 500 or so. So trading right around where my cursor is right now. So a clear breakdown in another AI leader, tech leader, software leader. And we've seen similar breakdowns in companies that we've liked in the past, such as MongoDB, ServiceNow. So across the board, we're seeing high multiple software names bite the dust. On the other side, we're seeing these value sectors break out. We see copper here breaking out. I want to note 55% of copper demand comes from China. Now, if China's going down an economic vortex and going to zero, well, why is copper breaking out? Its biggest customer, China, remember, 55% of every ton of copper that is produced goes to China. So what is the market trying to tell us through pictures? What are these symptoms trying to tell us about the real state of what might be happening in China? Could something be happening in China that's suggestive of maybe a bottom? We don't know that, but the symptoms suggest that maybe market narratives are misplaced relative to the reality. Oil. China's the largest consumer notionally of oil. Oil breaking above 80. Remember, we were below 70 a few months ago. We're now breaking above 80. What is the market trying to tell us? We believe oil is both a demand and supply story. We see here Saudi Arabian supply has continued to fall. While the US supply has risen, or production has risen, we think we're near a peak there too. So we really love the energy names here. You see that reflected across our equity portfolios, and we'll continue to do so. Why do we like energy stocks so much? Global oil demand is rising, supply constraints due to long-term lack of capital investment into the ground across the world. And then, of course, shale consolidation, which we believe will lead to higher dividends and higher stock buybacks over the next few years. We would also note the percentage of stocks in the S&P energy sector, now it's 65-day highs, has reached 57%. You're starting to see this structural movement back into the sector. We believe we're in the second or third inning of a multi-year bull market. So what are the key takeaways from this week? Inflation keeps bouncing. We want to watch that. What does it mean for asset allocation? Well, value over growth, in our opinion. So the S&P can very well go down, and a lot of people could very well make money if they have a value orientation. That's what we believe. We could be wrong. Number two, number of broken tech stocks keeps rising and keeps increasing in number. And then lastly, commodities and emerging markets are showing signs of life despite deep pessimism for those countries and their economies, that copper, oil, the actual stocks in those countries, they're doing something that is not analogous with what's the market narrative and the media narrative about what's happening in those countries. So we want to pay attention to those symptoms. So that's what we got for you this week. 888-543-3776. If you got any questions or concerns, please feel free to reach out to your advisor, and have an absolutely fantastic week. And thank you again.